Welcome to Dominant Investing Strategies. Today we will discuss Elliott Wave Theory. Remember, each strategy takes time and practice. In this tutorial, you will learn financial patterns, or waves, market predictions based on wave patterns, and the potential drawbacks to Elliott Wave Theory. What are waves? Elliott found that swings in mass psychology always showed up in the same recurring fractal patterns, or waves, in financial markets. Elliott's theory recognizes that stock prices move in these waves. Elliott was able to break down and analyze them in much greater detail, discovering stock index price patterns were structured in a fractal way. Fractals are mathematical structures which, on an ever smaller scale, infinitely repeat themselves. He then began to look at how these repeating patterns could be used as predictive indicators of future market moves, and thus Elliott Wave Theory was born. So what makes up Elliott Wave Theory? There's a few basic concepts. There are impulse waves and corrective waves. An impulse wave is a wave which net travels in the same direction as the larger trend. A corrective wave, on the other hand, net travels in the opposite direction of the main trend. A trend shows the main direction where the price of a particular stock or index is headed. An upward trend is generated when the demand is greater than the supply, which results in the high increase. After some time, stocks become oversold, which causes supply to be greater than demand. This is when the correction takes place. Elliott Wave Theory interprets these demand-supply interplays as a 5-3 rule. This means that there will be 5 waves that move towards the trend of an underlying asset, followed by 3 corrective waves. Waves 1, 2, 3, 4, and 5 form an impulse, and waves A, B, C, the 3 corrective waves, form a correction. Importantly, the larger market consists of smaller waves when minimized. Note that since Elliott Wave Theory considers the market as a fractal of these waves, then zooming in on a corrective wave within a greater impulse would reveal the same 5-3 patterns occurring. So when is the money made? At point 5 in a downward trending impulse, after 5 waves move toward the same general trend, a trader might purchase call options or stocks, predicting that there will be a 3-wave correction upward. Then they might sell once the correction has been made. For an upward trend, the behavior would likely be the opposite. 5 would be the highest point, and this is where the trader might purchase long-term put options, while at the same time hedging with calls to sell during point B, the crest of the correction. It is important to mention that simply because the market is fractal does not make it easily predictable. In terms of practical application, Elliott Wave Theory has its devotees and its detractors, like all other analysis methods. One of the key drawbacks is that the practitioners can always blame their reading of the charts rather than weaknesses in the theory itself. Failing that, there is the open-ended interpretation of how long a wave takes to complete. That said, the traders who commit to Elliott Wave Theory passionately defend it. Stock prices move in waves. Price patterns move in fractal ways. Elliott Wave Theory is generally a 5-3 wave pattern, where we have 5 waves moving toward the trend of the particular stock or index fund to form an impulse, while the following 3 waves are corrective. Like any analysis method, it is important to practice this theory. Waves just help you analyze the potential retracements from general trends and identify corrections to better enter a position. This does not mean that the market will 100% follow the same waves every time. Before entering a position, you need to wait for a confirmation that the market is entering correction waves. Thank you for watching this video. Please subscribe and like this video if you found this information to be useful. We wish you successful trading, and let us know in the comments if you have any questions.